Good afternoon to all our participants. Thank you for joining today's Green Tech Dialogues on High Quality Financial Statement under IND AS Auditor and Companies Perspective Part 1, featuring Mr. Chandan Lahoti, partner Ahuja Walecha and Associates. Chandan Lahoti is a partner with AVA Network and is responsible for corporate development and strategy within the group. Before this, he was associated with EY for 16 years and was servicing as a director and specialized in statutory audits. He has worked on audit assurance engagement of large multinationals in India as well as overseas. As a part of EY, he has led and managed audit of large listed entities, including Cummins India, Bharat Forge, Atlas Copco, Eaton, etc. He has, in fact, worked on diverse industry.
Sir, I'll introduce you. Everyone, we have Mr. Chandan Lahoti, partner with AVA Network, as our speaker for today. Surbhi has introduced him a bit, but let me tell you more about her. He has worked on the audit assurance engagement of large multinationals in India as well as overseas. As part of EVA, he has led and managed audit of large listed entities, including Cummins India, Bharat Forge, Atlas Copco, etc. We welcome you, sir. And before we dive into today's session, I would want to inform our participants that in the last 10 minutes, we will host a dedicated Q&A session. So participants, please feel free to post your queries in the Zoom Q&A box. With any further ado, let me hand it over to you, sir.
Thank you, Anjur. Thank you, Surbhi. Thanks for that brief introduction. And I think so, without wasting any further time, let me directly start on today's topic, and let's discuss and have a brainstorm discussion only on the today's topic. My presentation is clear, Surbhi? Can you see that?
Yes.
Okay. Thank you. Thanks, everyone, for joining today's session. I just want to understand a bit about the audience. So I would just request all of you to mention in the chat box, okay, about your knowledge on IND AS, whether you are a newcomer to foreign IND AS or you are an average, having an average knowledge on IND AS, good knowledge on IND AS, or an expert knowledge in IND AS. Basis that, I think so, we'll take the flow of today's session for next 60-65 minutes. Is that fine? I'll just wait for some time until I get some of the chat messages. I think so. Thanks, Prashant, to start it. Okay, good. Jay says he has a good knowledge, average. Okay, few more so that, okay. So, Shubham is saying I'm beginner on IND AS. That's good, average. Okay, so currently what I could see, there are few who have mentioned a good knowledge, excellent knowledge, but most of the people I could see they are mentioning as an average knowledge. So that's good. So that I'm aware that most of you who are on today's session knows IND AS and knows what about IND AS requirements, etc. So that it helps me to understand and take it forward from there. So today what we will be discussing would be so I think so Anjor or Surbhi has not informed about. We are planning 3 series on the IND AS related common errors in the IND AS financial statement. One is planned in Jan, second would be in the month of Feb and month of March. And over next 3 series, what I have done, I have tried to cover more than 100 odd commonly found issues and errors in the IND AS financial statement, okay, across all the industries, across all the standards. So what I would be doing, I would be covering all the standards between these 3 series. So today, my agenda would be to cover IND AS 1, 2, 7, 8, and 12. And in the next series, we would be covering the other IND AS. But I would cover all the IND AS from the disclosure perspective, and majorly when I mean disclosure, the disclosures which I believe were not appropriately disclosed in the financial statement and has been identified as an issue by NAFRA, by FRRB and various other authorities across here. Before we jump into commonly found issues in IND AS, I just want to explain between the real difference between the IGAP and the IND AS. And few of you can just put on the chat box what are the real differences between an IND AS and an IGAP. We all were using an IGAP for several years, I would say over 50, 60 years in India. And the accounting standard started from last 30 odd years. Suddenly in 2016 onwards, IND AS came, and now we are discussing about IND AS. And hence, the biggest problem is we have certain set of knowledge under an IGAP, and we try to apply that in IND AS. That's a huge change, really. In essence, it's there, and hence that mindset change is required. I could see some historical versus fair value, fair valuation, etc. What I will do, two or three key changes what I believe between an IGAP and IND AS we'll discuss today. In the next series 2 and series 3, I'll just discuss on further more IND AS related huge differences between the gap, not at a standard level, but definitely at an overall concept level. So someone mentioned historical versus fair value. It's correct. Book value versus fair value is something which is a huge difference between an IGAP and IND AS. Historically, in all the financial statement in IGAP or now which we prepare at a book value, which is called an historic value, and in exception as a revaluations. But under IND AS, the concept isn't fair value accounting and fair value disclosures. And there are standard which says when fair value and when it should not be a fair value, etc. But it says unfair value, but it says the historical value or the book value can be same with the fair value, and hence accordingly those are there. The second most important is on substance over form. So give few of the examples. If, for example, something is written in an agreement, doesn't mean the accounting need to be done what is written in agreement. It says go to the crux of a transaction, understand the transaction. Like in IND AS 115, IND AS 116, Prashant rightly said, these are the few of the standards which we are using on a day-to-day basis, where it says you should not go what is written in an agreement only, but find the real essence of a transaction. And the third most key change what we see today is off balance sheet item coming on the balance sheet, such as leases, such as corporate guarantees, which were just coming in our note stock accounts. Now they are coming to the balance sheet. Good. Okay. Now what we'll do, we will discuss about few of the key changes or few of the key observations under IND AS in IND AS 1. I will request you to put your questions on the chat box. If you have any questions with regard to any of the agenda items or any of the items, you can put on the chat box. And if it's not clarified by me during the session, either in between or at the end, I will clarify on all those items. If you see, one of the key error what was identified was company has incurred several expenses, and all those several expenses which were incurred were shown in CWIP. And all those items which were shown in CWIP were disclosed under intangible asset under development. We'll discuss what it should be. And the second, the company has also disclosed the leasehold land under tangible assets. I'll just request all of you, if you find any issue in both these points in the chat box, you can just type in the chat box if you feel there were some issues. So the first item, if there are expenses incurred by the company and those expenses were parked in a CWIP, those expenses can be relating to the tangible assets, can be related to intangible assets. Not necessarily it should go under intangible assets only. Secondly, if it's only related to intangible assets or a tangible assets, as the case may be, the disclosure need to be there in the significant accounting policy, which was also missing in the financial statement. Further, the leasehold land, which is disclosed under tangible assets, which was incorrectly done, and reason, logic, etc., was not explained in the financial statement. Just hold, I can see chats. Yeah, better. So on the next matter, if you see, and this is a very typical matter and typical issues what I have seen and identified in several financial statement. One of the company in their financial statement has disclosed an investment under equity as a subsidiary company. However, in MGT9 form, which was submitted as part of the director's report, the investment was disclosed an associate. So at an initial stage, an identification of an investment, there was a contradictory at first place. Secondly, what has happened, uh, over and above that contradiction of disclosing that entity as a subsidiary and associates, in the notes to accounts, in the significant accounting policy, the same entity was disclosed as a fellow subsidiary and also as a jointly controlled entity. As most of you might be aware that all these terminologies are different. Invest subsidiary is different, fellow subsidiary is different, jointly controlled entities are totally different. So as you are aware, and further if you see in the fellow subsidiary also, those items were disclosed as an exceptions item. Accordingly, overall, from a financial statement perspective, it could be very easily identified that these are the issues which were very glary at a financial statement. If you see over next 50-60 minutes, I would be discussing on few of the issues which are contradictory from the financial statement perspective. If you have any questions with regard to how, what it should be, we will discuss. But this is happening significantly in a lot of financial statement where different disclosures are being done. Yeah. How to disclose companies with the same management and a shareholder. So for example, if a company is under the same management, same management and the same shareholder, I'm assuming that they are related party of your parent company. If that's the case, then it should be shown as a fellow subsidiary. Fellow subsidiary is not your own subsidiary, nor your parent, but your parent's subsidiary are called fellow subsidiaries. Okay. Next, under if individual shareholders in both companies still, if there is a common parent, they would be called as a fellow subsidiary in either of the cases. The next, what you see from an IGAP perspective, let's assume now in IGAP, we see a lot of reserves being created in IGAP financial statement, such as capital redemption reserve, security premium, general reserves, etc. The key difference between the IGAP and IND AS, from an IND AS perspective, whenever there are any items which are disclosed, you need to explain them further for better presentation, for better understanding, or better clarity to the reader of the financial statement. And accordingly, yes, we are talking about other equity. Under other equity, Percy, it need to be specifically required to give the nature and the purpose of these reserves. In the current financial statement which I am referring to, it was forming part of the other equity, but the nature and purpose of each reserve is not given. When I mean this, for example, it's a capital redemption reserve. You need to explain this capital redemption reserve was created in so and so year for so and so transaction happened in that particular year, or you need to give furthermore elaborate the nature and the purpose for every other equity items. Is it clear? Anyone has any questions till now? Am I going fast? You want any of the items to be discussed further? Okay. Thanks, Saurabh. That helps. Okay. On the next item, which is very typical, and before going into this matter, I would explain before Schedule 3 under IGAP, everything was classified just as a current, non-current. There was no clear definition of what would be the current assets and non-current assets and how to classify them. So can someone put on the chat box, what is the key difference between classification of current and non-current for an asset and liability? There's a huge difference between definition of a current asset and a current liability vis-a-vis non-current assets and non-current liability. And we will discuss that issue here so that everyone has that clarity. And I see this issue in IGAP under IND AS. Anyone, I'll just wait for some time. I want a key difference between non-current asset and a non-current liability. No, so I think so. Few of you have no. So these are definitions between current and non-current. I am saying there is a huge difference between, correct, Poonam, I think so you are very nearby. So current and non-current operating cycle, no, Percy. It's about an a current and non-current asset is if a company is expecting money out of that financial asset in next 12 months, then it's a current assets. If the management or the company expects that the money they would receive after 12 months, that is a non-current. That is basis the expectation of a management. For liability, the definition of current and non-current under an IGAP or an IND AS or an IFRS clearly states that for liability, it would be term of an agreement, term with the trade payable, term with the loan, terms. So I'll just, and I think so you would be very clear once I say this. For example, there is a borrowing which you're taking from a related party, and you know that you will not pay in next 2, 3, 4 years. But the term is repayable on demand. It would be always current. Similar example, if so, Prashant, conservative approach would not be fine under IND AS. It has to be in black and white. From an asset side, if you expect money, you need to disclose current, non-current. And from a liability side, it has to be basis the terms. So I will tell you one more example. There are few trade payables within the group companies. You know you might not pay them. You don't disclose them non-current. You disclose them current. So liability side, it has to be current or non-current basis the terms agreement. From an asset side, even if term is 60 days, 90 days, you will disclose those assets if you expect to receive after 12 months as non-current. Clear? Rinkin, the counter entity has no right to delay payment beyond 12 months. That's fine. But if they don't have a right to delay, but they delay it, basis that it is there. And if you're talking from a liability perspective, from a liability perspective, if they don't have a right to delay, even if they delay, they will still disclose as a current because the terms are less than 12 months. Is it clear? Because this is very important and I see across in IGAP under IND AS this issue and this error. If required, we can spend more time on this matter so that it's clarified, and we can take several examples if you have where you find what it should be disclosed. Now or later, as the case may be. Okay. Going to the next slide, if you see from a financial statement perspective, when you prepare your accounting policy, very clear it should not be boilerplate. When I mean boilerplate, I see most of the financial statement prepared from the good books or the standard formats of various firms or from a previous year as the case may be. For IND AS, every company has a different set of policies, different set of accounting treatments, and accordingly different it should be disclosed. Now, if you see on the left side, in that financial statement, it was mentioned that the financial statement has been prepared on historical basis, except certain financial liability that are measured at fair value and defined benefits planned assets measured at fair value. These are the two items only mentioned specifically. However, it was noted that disclosure regarding financial instrument category, all financial liability has been measured at amortized cost. You're getting my point? Further, certain financial assets like equity instrument has been measured at a fair value. So clear cut difference between what was accounted, what was disclosed in the financial statement and in policy. And this issue I see in most of the financial statement. What most of us we do, we just do copy paste of the financial statement and we don't go into detail about why and what. Is it clear? Okay, very good. On this particular matter, I'll just pause for 20-30 seconds, just read that, and I wanted this full content available so that you'll understand what this issue is, and these are type of issues which we see in a lot of financial statement, and I will then explain in detail. So, as part of the restructuring, basis the consultant, an advance was received from an XYZ company and still the structuring was not completed. Typically, what you believe, and I want minimum 4-5 answers. What you believe, what disclosure need to be done at an year end because the transaction is still not completed and advance is received. Some responses. In chat box, I can't see any. There are more than 104 participants. Some of you can. No one? And this is very basic because this will not, show as advance, but anything more required? And rather than going into under the financial liability disclosure in FS, non-financial, no, correct. A note on FS for particular advance is very important. It was noted that the above statement notes that the company received advance earlier from a part of construction. However, the company did not specify under which heading the said amount has to be reported, and giving a note in detail about why, what, etc. Aging of advance, etc. Correct. That is furthermore enhanced disclosure, Geet, you are mentioning, but yes, that's the correct answer. So just see some of the items. So what does IND AS is saying and expecting from us? Please disclose and give clarity about a transaction in the financial statements. That's all. Coming to next is okay. Very good. Under IND AS, can we disclose extraordinary item in the financial statement? Yes and no. And if no, why? And if yes, why? Nikhil and Percy says no. And if so, no, why no? Just think about it. Okay. Shubham, thank you. I was to tell that. Correct. Under IND AS, extraordinary item is not allowed to be disclosed, but we see a lot of financial statement till date that they disclose items as an extraordinary item. However, exceptional items, if any, at a point of time, if they are allowed to be disclosed as an exception item with a detailed note. Based on materially, can they disclose? Maulali, no. Even if it's material, you can't disclose an extraordinary item because there is no concept of extraordinary item under IND AS. And exceptional item you disclose only on a material basis. Hope that answers your query. No, that those are also been disclosed and yeah, on in IND AS, which, when, how you disclose an exceptional item and not as an extraordinary item. Okay. Now, other income with a significant amount. Okay. So in other income, one of the item, this is other income. Other income includes amount received to all technical services provided by the company. This amount is significant. Okay. Any additional disclosure is required in full financial statement with regard to this amount. This is a significant amount. Yes. Shweta, then what? And where? Where? I'm just waiting for an answer. As part of notes, already coming, Shweta. Other income includes amount received from technical fees of the company. Shalini, the note stock accounts already coming. So, okay, let me clarify for the new joiners or for the average knowledge, having average knowledge on the IND AS from a structure perspective of a financial statement. Let me explain you the structure. You see balance sheet, statement of profit loss account, cash flow, OCI, correct? That's the first part. Then comes the corporate information, accounting policy. That's the crux of the financial statement. Then are the notes. Notes doesn't mean notes to account. Notes, when I mean, those are typically those notes to the balance sheet. Note 1, note 2, note 3, note 4, fixed assets, etc. Those are the notes what I'm trying to tell you. Okay. So IND AS clearly says what should form part of accounting policy, what should form parts of notes. And here I want an answer from few of you. What should go in accounting policy section and what should go in notes section? I'm just waiting. Transaction specific in notes. Okay, Prashant. And what in accounting policy? And few of you might brainstorm and put your thoughts. Okay, definitely few of the items what should go in notes will form part of your schedule to the Companies Act formats, and specifically the items which are mentioned in the respective IND AS sections. So if you see an IND AS is bifurcated and at the end there is written other disclosures. So all those items which are written in other disclosures in that audit, in that IND AS, should form of notes to financial statement, and the preparation of the financial statement should form part of the notes to accounts. However, in accounting policy, one need to explain the significant transactions or significant policies of the company to deal with the situation. Okay. And accordingly, I'll just, so what has happened in the current case, 94% of the total income was shown as other income, and there was no policy for this item. And accordingly, it need to be disclosed in the accounting policy how what it need to be done. Now, some of you have mentioned that this should form part of revenue. The question is, company might be into one of the business lines in which they are running the company, and the current turnover of the company is very minimal. But as an exceptional item or as in one-off item, if this money company has received toward those technical services, it can't be shown as a revenue. Yes. So perceive what you mentioned is a material accounting policy information and not significant accounting policy information. The difference perceive here is significant versus material. Okay, that is only being clarified in MCA circular and the new change, and not yeah. So material accounting policy should be disclosed in the significant accounting policy section. We are talking about significant accounting policy section, and in the significant accounting policy section, what need to be disclosed is a material accounting policy. That's being explained. Investment income can be more than agreed even. Okay. Here, more detailed about the items what we were discussing till now. A lot of disclosures were not disclosed in an accounting policy. So for example, company has trade receivable, investments, etc. There should be section of financial assets and financial liability in the accounting policy, which was missing. And further to it, recognition and measurement of those financial assets and liability was missing, which need to be disclosed. Anything till now on IND AS 1, because then we will go to the next, which is IND AS 2 on inventories. Till now, any other questions? Okay, good. Very, very important point. And I think so. Let me see if anyone can put on the chat box the item which I have marked in red. So the accounting policy of inventory reads as follows. Inventories are stated at lower of cost and fair value. Two of you have said NRV. One has said realizable value. I'll just hold. Correct. Now, what is the difference between a fair value? Okay. Poonam, arm's length price. No, that's not correct. it's a net realizable value, which cost and net realizable value. Second, what is the difference between a fair value and a net realizable value? Because that is also important. So we would be discussing two items here. One is what should be the accounting policy and how it to be measured. What is the difference between net realizable value and fair value? Anyone give a thought? Waiting for you. NRV entity specific, transaction cost, fair values and asset specific. NRV is selling price, fair value, value sale price. Monica and someone before Monica. Geet, Monica, you are somewhat nearer. No, Tejas, Tejas, I think so. You mentioned fair values between the knowledgeable willing party in the open market. No, no. Okay. So I've just put that for all of you, and which is very important because what happens as part of the valuation. So as an company or as an auditor, we need to identify what is net realizable value of a company and need to account for. Many companies at times in an accounting policy writes that we have accounted inventory at cost and net realizable value, but in essence they do cost and fair value. And hence I thought of discussing that in detail about what is can you hope you understand from the literature what I have placed here. If you have any questions we can discuss, but we need to do basis the expectations of the realizable value what we will realize from the sale of an inventory, less of cost of completion and estimated cost of sales, and not what is openly sold in the market or open market transactions. And hence the disclosure was incorrect, and probably in the financial statement there might be issue between the valuation also. So Shalini, simple example is an inventory. Take any finished goods, which, for example, you have a finished goods of, we will take an example of, for any automotive component which is being sold. So for example, the raw material, currently companies sell that product at 100. The cost of completion of that product, raw material plus overheads, less of freight, etc., is 80 rupees. But for that particular item, if that is sold in the market, what it would be fair value? Shalini, I'll ask you, what would be its fair value? Fair value would be 100, 110, 90, whatever is then agreed price between both the parties. And hence, from an inventory perspective, it has to be a price, an NRV to it, and not the selling price. Go to the next. Okay. We'll go to the cash flow, and from a cash flow perspective, significant issues. Okay, I forgot to tell you which are the three standards what you believe will have or rather will were identified as a significant issues by FRRB and NAFRA. Which are those three standards which you believe are the ones where significant issues are there in the financial statement? Saurabh says 24, Rinkin says 109, 105, 107. Okay, hold on. Definitely not 115, 10. So the first is IND AS 1, presentation and disclosure. The issues identified in IND AS 1 is the highest, not 101. The second and the third are 107 and 109. Where in last 7-8 years by FRRB, by NAFRA, the issues identified at a financial statement level were the highest. And hence I thought of discussing more in detail about 10 or IND AS 1. Second, okay, going to this issue, in the cash flow statement of the company, certain items were reported as repayment of the external commercial borrowing under the head cash flow for financial activity. It was noted that the balance of external borrowing reduced from the previous year. So to give you an example, what has happened under cash flow, opening closing difference was shown as a repayment. Is that correct? And if not, what should be the correct treatment? What should be the correct treatment? Very simple. No gap difference. Same in Index, same in IGAP. You are correct, but how to identify that? Actual need to be disclosed. My friend, Percy, you said no actual payment and actual borrowing should be disclosed separately. That is correct. But how to identify if someone does a disclosure of an opening and closing difference? How to identify that at a face? Exactly. I think so. Geet is correct because I've mentioned this is an external commercial borrowing. And once it's an external commercial borrowing, the difference will also have a forex difference. And that need to be factored. This is one of the example I'm just telling this. So one need to be very much careful when you disclose the items in a cash flow, and cash flow is prepared when first or last. Cash flows are prepared first or last. Last. So chances of errors in that cash flow is highest or lowest? And same in an IGAP and same in Index, we see a lot of issues being identified at a cash flow level. Next, very important. On left side, what do you believe? What is an issue here? In a cash flow, and also a issue is in non cash flow also, but we'll discuss that. So in current case, in the financial statement, tax expense has two line items. One is the tax for the current year and the tax adjustment for the earlier years. That is possible, correct? Those disclosures are done in the financial statement, in the statement of profit and loss account. From a cash flow perspective, those amounts were matching. Practically possible, not possible, correct, incorrect? And what is an issue here? So from a financial statement perspective, the disclosure in the statement of profit and loss account was correct, because if it's a current year adjustment and if it's a prior year adjustment, it is being disclosed. But if it's a previous year disclosure, taxes are not paid for it. It's not a cash flow item. It is about an adjustment with regard to and tax balance which was shown in the balance sheet, which got flushed to the P&L post assessment, etc. Yes, they just actual tax payment need to be shown in the cash flow and not the tax expense what is being shown in so 2-3 issues in this particular issue. One, tax expense for earlier years If crystallized now is not a prior period. Someone said it's as a prior period. If you have still issue, we can discuss. It's not a prior period. Point one. Point two, the tax expense in the P&L in statement of profit and loss account is not the same tax expense in the cash flow. Third, the actual tax outflow might be more or a lesser as compared to A. So for example, current year tax expenses is rupees 100, but in a cash flow, the current tax paid is 120. 20 might be for self-assessment for earlier year. Possible? Accordingly, that need to be disclosed. So 3-4 typical issues in this one issue. Correct. Rinkin, you are correct. Similarly, under cash flow, this is very typical. Every index company preparing cash flow has this an issue. And can anyone explain me what is an issue? Post reading the issue, what it would have happened and what one need to take care of it. Because under the statement of profit and loss account, the OCI remeasurement differences of an employee benefits is sitting in an OCI. And where do you start cash flow? Cash flow starts with which line item? NP before tax, PBT, and remeasurement of a defined benefit plan is sitting in NP, net profit before tax. Yes or no? No. Correct? Shalini is saying yes. After no, I am asking whether the first line item in a cash flow, profit before tax, includes remeasurement differences. Yes or no? No. Okay. And hence the difference of those items need to be factored in a cash flow in an appropriate manner. I'm just through these issues, I'm just trying to explain you few of the issues, few of the disclosure issues, few of the valuation measurement issues, what one need to take care as part of your Ind AS accounting, auditing by company, by auditor, as the case may be. Okay. So typically, if you see in a cash flow, they were disclosing capital expenditure as a cash flow from an investment activity. Correct? Incorrect? What they should have treated appropriately here? Is it correct? Incorrect? And if it's incorrect, I think so. This is very simple, no brainer for all of us. Great. Similarly, under cash and cash flow balances, etc., as all of us know, under Ind AS and an IGAP, the huge difference between, okay, before that, hold on. What is difference between cash and cash equivalent and cash and bank balance? Type in chat box. Type in a chat box, what is the difference between cash and cash equivalent and cash and bank balance? Okay, Poonam. Cash equivalent includes readily realizable liquid assets from ranges. Okay. It includes deposit. Deposit more than 3 months, less than 3 months. Great, great. I think so. All of you have got it. What was an issue in the current financial statement, how it need to be disclosed. and why it was incorrect, why the margin money, etc., was not disclosed correctly? Yes, Rinkin, go ahead. You can ask the question. What is treatment? Rinkin, I am not clear. Of debt mutual fund readily available. So, for example, if it's a debt mutual fund and this explanation is given clearly under an IND AS, you need to first identify whether that asset is readily available at the same value or not. So, there are three types of asset class: a liquid fund, a debt other than liquid fund, and an equity mutual fund. Okay. All these three items, do you believe at any and every point of time the value of that asset, what company will realize, would be same or different? There are chances of risk or not risk. Rinkin, risk. The insignificant risk is also been defined. What is called as insignificant risk, what is called as not insignificant risk. You believe they have an insignificant risk, but at times companies have seen liquid market drastically changing for 1 or 2 days more than 20-30%, correct? You have seen that, Rinkin, that there are times when the liquid fund has also was in red. Very rare, but yes. And accordingly, those are not disclosed in cash and cash equivalent, and those are disclosed in investments for any and every company. Similarly is for gold. Gold, you don't, if a company has a gold, you don't show in cash and cash equivalent, correct? Have anyone seen or believe that the gold held by the company, if any, need to be shown as a cash and cash equivalent? Okay, good. Is it clear, Rinkin, or anyone else any doubt on identifying liquid items or liquid assets, debt assets, whether it's classified as an investment or classified as a cash and cash equivalent? If anyone has any questions, just put on your chat box and we'll discuss and answer. Okay. First basic questions. Prior period. Prashant, where to disclose sweep account balance, wherein it's in and out of the sweep within less than 90 days, should be disclosed in cash and cash equivalent. In current account or deposit, as the case may be, it too would be cash and cash equivalent. Okay, now let's go to the next. If anything is there for an earlier standard, we'll take up at the end. Basic question, prior period items, allowed, not allowed, to be disclosed in the financial statement under IND AS. Percy, just hold on. Before that, we want to understand whether in prior period item, if there are, what to do. No. And if you identify prior period items, so Geet, you please respond. If, for example, and also Girish and Prashant. Oh, Prashant, this is something different what I'm hearing. So first, if there is a prior period item, what need to be done? Poonam, answer of restatement is incorrect. Adjusted Percy incorrect. Third balance sheet incorrect. We are just jumping to the conclusions. First of all, the standard clearly says you need to identify whether there is a prior period item or not. If it's a prior period item, one need to assess whether that is material prior period item or not. If it's a material prior period item, then the discussions will come. If it's not material, you need to classify them in the respective head of expenses and not as a prior period. That's the first. Is that clear to all, or anyone has any doubt? Let's go step by step. We have 10 or 15 minutes. In 10 or 15 minutes, I will discuss and close everything. Clear? Point one. Point two. If there are prior period items in P&L, the treatment is different. If the prior period item are in balance sheet, the different prior period item is wrong classification. The item is different. So, for example, there are prior period items which are material in nature. Okay, material in nature. Then you need to draw. You need to draw third balance sheet P&L as third balance sheet if it's pertaining to a previous period, otherwise not. And if it's a balance sheet, you need to understand whether it's a pervasive to the financial statement or not, and accordingly you do disclosure or change in the financial statement or just a note to the notes to accounts. So you might have seen some of the financial statement have a note for reclassification of balance sheet item for the previous year if it's significant. Is that clear? Yes, Percy, you are correct. Because there might be that is pertaining to an year before that, then you draw a third balance sheet, otherwise you don't. And not opening balance sheet. So Percy, there is a difference between uh, first time adoption and a continuous case. First time adoption, definitely always it's a opening balance sheet. From recurring in nature companies, they draw third balance sheet, and that too if it's pertaining to earlier years. Is that clear to all of you on prior period item? And that's the yeah. So what company had done? Company had restated prior period item, etc. Someone has mentioned that the if it's a prior period item, it will go to reserve. Who was that? And you are you clear now, or you want to discuss that in detail? Because I saw some of you have mentioning that the prior period items goes to reserves. Okay. Preliminary expenses allowed under IGAP, under IND AS? Yes, no. If yes, what is the treatment? We are to the next point. We are on slide 23. Only 5 more slides, 5 more points. Anyone not allowed under IND AS? Tejas, allowed under IGAP? Percy says no. Tejas says no. Shalini says yes. No. Okay. So first of all, preliminary expenses is not allowed, or there is no concept of preliminary expenses under IND AS. However, we are seeing these items being disclosed in the financial statement, because in long back in IGAP it was there, but it stopped several years back, and there are several clarification when AS 26 came long back. I'm talking about but preliminary expenses still is a concept under income tax. And under income tax, the preliminary expenses are apportioned over the period of 5 years. And hence, there is a mismatch between both things. Yes, section 35D says about IND AS. About preliminary expenses. Income tax, last section, 3 slides. Okay. In OCI, in statement of profit loss account, an item is disclosed as a remeasurement of defined benefit, etc., gratuity, related details being disclosed. Gross of tax to be disclosed, net of tax to be disclosed, or separate two line items to be disclosed? That's a question to all of you. Just imagine statement of profit loss account, OCI section. In OCI, there is a remeasurement benefit which is sitting in a P&L, need to be disclosed net of tax, both allowed, either net or both separate, net of tax or separately line item. No. Percy, net of tax or separately line item for tax? No. So there would be always three line items: the gross amount, the tax amount, and the net amount. All are, I was referring to book, and so all three are mandatorily required to be disclosed uh, in the financial statement, and not just here. Yes, Shalini, you are correct. All remanagement define need tax impact separately. That means gross, tax, net. Clear? Typical issue in IND AS. And the next one is my favorite, but let's discuss this particular item. In the financial statement, the left side treatment is correct or incorrect? Whether the treatment of disclosing deferred tax assets and deferred tax liability in a schedule 4A, 4B is correct or incorrect? No, yeah, Nikhil Garg, it should not be either DTA or DTL. It should be netted off always in all cases. But you will see a lot of financials or the notes still they showing separate line items. Perfect. Under IND AS, the last point for the day, and then if we have any questions, etc., we'll discuss. You can unmute your videos, etc. Okay. Reasonable certainty and virtual certainty. Now we are on the next. Is there any concept of reasonable certainty or virtual certainty under IND AS 22, IND AS 12? Yes or no? Okay, Percy is saying reasonable certainty and not virtual certainty. Yes, reasonable certainty. Can someone Google right now and check whether it's reasonable certainty, virtual certainty, or something else? Okay, Rinkin. So first of all, can someone explain what is the difference between reasonable certainty and virtual certainty? Girish, I am referring to IND AS 12. More likely than not is what, Percy? Degree of assurance. Okay. So under IND AS 12, it says the term probable. First of all. So in case of IND AS, it says you need to recognize deferred tax basis the probability of those assets being reversible in the near future. First, however, reasonable certainty and term probable from a definition per se are same, but the term probable being used under IND AS 12. Reasonable certainty term has been used in various other IND AS, but not under IND AS 12. That's point one. Point two, just on this, just a question, and please answer. If there is a loss in a company and management believes in next 2, 3, 5 years, basis the model which they have prepared, they believe that the deferred tax asset to be created on the loss made by the company. Do you believe under IND AS it's okay to create the deferred tax asset? Yes or no? Yes or no? If you are saying yes, if you are saying no, All are saying yes. If you, yes, yes, yes. Others, yes or no? TTA only allowed if company expect profit in future years to said, yes, it's Geet, it's there, but it's basis the future forecast. Okay, the same question I gap. Same question I gap. Management believes in next 5 years there would be profit, and on that profit they would recoup whether a deferred tax asset to be created. Yes, no. Few says yes, few says no. Okay, very clear. Just I will explain the last concept between the virtual. Under IGAP, it says virtual certainty. Under IND AS, it said term probable. That's a huge gap difference between IND AS and IGAP. What is virtual certainty? Virtual certainty is clear where you have confirmed signed orders, and on the basis of that signed confirmed orders, you are getting profit. Then it's a virtual certainty. Virtual certainty is very, very uh, important concept. In an IND AS 22, it is clearly written that if you have signed confirmed contracts and profit is earned through those signed confirmed contracts, then only you recognize deferred tax asset, otherwise you don't. Okay, clear. I think so. That's all for today's session with regard to the items point I wanted to discuss. But feel free to put any of your questions what you might have with regard to above any points or any other points. We can spend some 5 or minutes to resolve those questions on a chat box. If some of you want to unmute, you can unmute and we can uh, discuss about few of the items. Anjur, just let me know, is it possible for others to unmute and they, or they need to just put on chat box? How's
Sir, we cannot unmute everyone, but we have a question from Mr. Harshit Khurana. IPO expenditure is shown as current asset. After successful IPO, what should be done for the same?
okay? Okay, it was in a question and answer. IPO expenditure is shown as a current asset. Okay, after successful IPO, what should be done for a same? I think so. The Harshit, it is very clear that the expenditure which is incurred for an IPO, if they don't test from an from an IND AS 36 perspective to be capitalized as an intangible assets, then they need to be charged off to statement of profit and loss account and not as a capitalizable item. One need to test it from an IND AS 36 perspective. Anyone else?
Yes, thank you, sir. One more question. Can flood expenses classified as exceptional items in IND AS and P&L?
If it's material significant, as the case may be, whatever terminology you want to, yes. If it's not material, it should not.
Yes, so we are done with the questions.
Anyone else? Okay, great.
Yes. Thank you so much, sir, for this interactive session today. You made it a point to analyze each and every aspect and clarify all the doubts of our participants. Thank you so much, and we will meet soon for the part 2 of the series, Quality Financial Statements under IND AS. Thank you, sir.
Sure. Thank you. Thanks, everyone. Thanks for your time.